David Kuo, co-founder at the Smart Investor. He's joining us from Singapore. So David, just looking at the market concerns given this conservative growth target out of China, to what extent is that cementing those fears that China will withhold stimulus, whether in the form of fiscal or monetary?
I think, Avril, the market hasn't quite decided whether or not China has set a relatively low growth target for this year in the hopes that it could bounce a lot higher than 5%, or whether it has set a target of around 5%, because that is really all it thinks the Chinese economy will be able to grow this year. So I think there is always, as ever, a bifurcation in the market. Those who think that China could easily beat 5%, and those who think that maybe this is going to be the path that China will be on for a very long time. In other words, its economy is going to be growing a lot more slowly, simply because the economy is maturing, Avril. And as most mature economies know, you don't really grow in double digits when the economy is getting older.
Regardless of why this target is coming in at that around 5% level, China might need to lean on domestic demand. What is that going to mean for the sectors that you are a bit more optimistic on?
Well, I'm glad you mentioned that, because as an economy starts to mature, then what you tend to find is that growth in that economy is going to be primarily driven by consumers. As we see in places like America, Europe, Australia, nearly 70% of economic growth actually comes from consumer spending. And that is a feature of a mature economy. And so what I think, will happen in China is that if we accept the fact that China is a maturing economy, then you have to look at consumers and say that this is where the growth is going to come from. And so, as always, you go and have a look at companies that are focused on consumer spending within the household. Things like consumer staples are always, an area that is very reliable as far as investors are concerned. So here in Singapore, we have a number of companies that are focused on the Chinese consumers. CapitaLand China Trust, for instance, operates shopping malls in China. It operates other things as well, but primarily it's in shopping malls. So if you believe that the Chinese consumers are going to be driving economic growth in China, then have a look at those types of companies. And as far as consumer staples are concerned, there are also lots of companies, overseas companies, that are targeting the Chinese market. And the ones that I particularly like are those big consumer titans like Unilever, Procter & Gamble, Reckitt Benckiser. I mean, those kind of companies manufacture goods that are sold worldwide. And all they really need to do is to sort of step up whatever productions they have in order to cater to the Chinese consumers. So that is one area. Another one is insurers. As an economy starts to mature, Avril, then people start thinking about long-term planning. They start thinking about their requirements when they are no longer working. So insurance companies are another one. There are some great Chinese companies that are focused on the insurance sector within China. So companies like Ping An Insurance, AIA. Then, of course, you have Prudential that is listed over in the UK. So there are plenty of companies. So I think whilst people are very worried about the slower growth rate in China, it is just a natural phenomenon. Any country will do exactly the same. It goes through that, even Singapore. I mean, we had phenomenal growth in the early days of Singapore, but now we're maturing. And that is something that investors need to accept.
What is this going to mean for the amount of support for the global economy that we can ultimately expect from China, though?
Right. Okay. People like to look back and say, back in 2008, when the world was in crisis after the great financial crisis, China stepped in and they sucked in a lot of commodities, and they started to build things like infrastructure, their railways, their roads, their airports, their railway stations. But this time it's not going to happen. I think for two reasons, because there are only so many airports that you can build in a city. And some of those tier one cities in China already have 3, if not 4 airports. So they don't need any more airports. They don't need any more roads. They've built all the roads they need. So that is not going to happen. That is number one. Number two is that back in 2008, China's debt to GDP was only around 30%. Today, China's debt to GDP is around 70%, if not higher. And so you wouldn't expect a country like China to be able to borrow heavily in order to do the kind of infrastructure building. So that's not going to happen anymore. But it doesn't mean that the Chinese consumers aren't going to be spending money. So I don't think we can look at the playbook back in 2008 and say what happened then is going to happen now. That isn't going to happen today. China doesn't really need to actually sort of build any more infrastructure, but it is going to be reliant on its consumers to start spending money. That, again, is another feature of a maturing economy. Your debt to GDP actually starts to become quite onerous. And so I am very confident about China. I'm very confident about the way that they're going to be pivoting from the previous growth plans to what is going to be happening in the future. In other words, looking more at the consumers and looking at more at consumer spending. And that is a much more reliable way of growing your economy than to actually pin your hopes on certain sectors, such as the growth sectors within that economy.
Support for all these other Asian economies, but in a different form, not so much infrastructure spending or manufacturing, but from the consumer sector in the Asian giant. David, thanks very much for sharing your analysis. Yeah. David Kuo, co-founder at The Smart Investor.